If you had exactly $10,000 to invest in real estate today, where would you put it? Most of the advice you'll find online tries to force a choice between two camps: the rental property purists who demand cash flow, and the REIT loyalists who prioritize passive dividends. On one side, you have real estate investment trusts, or REITs. This is fractional ownership in massive commercial portfolios that require absolutely zero personal management. On the other side, you have traditional rental properties. This is the direct ownership of a physical building, where your returns are largely driven by the use of bank debt. Choosing a side based on internet tribalism ignores your actual financial constraints. To find the right fit, we have to look at how the math has changed. The financial assumptions used to justify these strategies in 2020 have been replaced by a much tighter 2026 market. This chart shows how interest rates pressure one asset while boosting another. Elevated mortgages spike rental costs, slashing $400 monthly profits to $150. Simultaneously, higher rates drop REIT share prices. Since REITs must pay out 90% of income, yields hit historic 6 to 8% highs. With the baseline math behaving differently than it used to, passive REIT strategies are now highly competitive against traditional rentals. Finding a winning path in 2026 requires a strictly analytical approach. When we compare total return and cash flow, the biggest differentiator is the mechanical advantage of leverage. This graphic shows how a 20% down payment creates a multiplier effect. If you put $50,000 down on a $200,000 home and the value grows by 5%, you gain $10,000 in equity. That is a 20% return on your actual cash before a single rent check arrives. REITs historically deliver an impressive 11 to 12% total annual return, but they offer the individual investor no leverage. You are buying shares with cash, so your growth is linear rather than multiplied. But achieving those high rental returns requires a significant initial capital barrier. Lenders in 2026 are looking for substantial deposits in cash reserves. Those high entry costs also force you to concentrate your financial risk into one single physical asset in one specific town. Because today's margins are thin, you can no longer assume a rental will cash flow automatically. Finding a deal justifying the risk requires rigorous screening. I use DealCheck to verify the numbers on every potential property before committing. It provides the mathematical proof needed to see if a rental can still beat a passive REIT in this environment. Leverage is a powerful wealth accelerator, but using it converts your investment into a localized business with high entry fees. Beyond the numbers, you have to account for the two most overlooked costs of physical real estate: your time and your liquidity. Direct property management involves tenant screening, maintenance, and the risk of unexpected repairs. Even with a property manager taking their 8 to 12% cut, you are still the one making the final decisions. REITs eliminate all of that operational effort. They completely sever the link between how you spend your time and how much your assets yield. Then there's the timeline. Extracting equity from a physical house takes months and incurs heavy transaction fees. Publicly traded REITs, however, can be liquidated into cash in seconds during market hours, giving you near-instant access to your capital if you need it. The higher returns of a rental property are essentially your compensation for taking on an illiquid, labor-intensive second job. The final differentiator is tax efficiency, which becomes the deciding factor for anyone in a high-income bracket. REIT dividends are generally taxed as ordinary income, which is the least efficient way to receive investment returns. Physical rentals, however, benefit from a depreciation shield. The tax code allows you to deduct a portion of the building's value every year as an artificial loss. This means you can receive actual cash in your bank account while showing a loss on your tax return, effectively shielding your rental income from the IRS. You can also use a 1031 exchange to sell one property and buy another without paying immediate capital gains tax, allowing your wealth to compound uninterrupted. For high earners, these tax subsidies make the active effort of a rental property far more effective for preserving wealth than a REIT. The final decision rests on how your specific life constraints align with the requirements of each asset class. First, look at your capital. If you have under $5,000, real estate leverage is mathematically out of reach for now. Next, look at your timeline and temperament. If you might need your money back within 3 years, or if you refuse to manage tenants and toilets, physical property is off the table. In this scenario, the REIT strategy is the only viable path to build wealth while keeping your time and liquidity intact. The alternative path requires at least $20,000 in capital, a long-term horizon, and the willingness to take on an active role as an owner. An investment choice only fails if it actively conflicts with your available time, your capital limits, or your tax bracket. Intelligent investors don't view these two strategies as mutually exclusive. Many beginners use REITs to build their initial market exposure and savings without the burden of massive debt or management. Fundrise is an ideal starting point for this low-barrier passive strategy, allowing you to build foundational knowledge while your dividends compound. Real estate mastery means using REITs for passive diversification while you build the capital necessary to eventually deploy into carefully selected, leveraged rentals.